In this video, I interview macro and monetary analyst John Rubino. John is also an author and is the founder of dollarcollapse.com. And you're about to hear his invaluable insight on what we should expect in regard to inflation, implications of printing more money, our nation's debt crisis, bank failures, and bailouts. We also discuss the Federal Reserve's plan to lower interest rates and what will happen should they decide quantitative easing to keep the economy moving forward. We also discuss the false job reports in 2023 and the potential for supply chain disruption as the Red Sea crisis heats up. John also talks about the U.S. housing market. We're about to enter the spring market, and typically this is the absolute busiest time of the year for buyers and sellers. But this year, it may be everything but typical. And John knows a lot about the housing market. He wrote the book on it. Back in 2003, John wrote a book predicting the 2008 housing market crash, and he was right. So when John talks, I listen with complete respect. Now, without further ado, I'm honored to introduce you to Mr. John Rubino. John, welcome to the show and thanks for your time. Tell everyone a little bit about yourself and I want to know, why is it that you are right all of the time about predicting the markets?
Hey, Todd. Well, that's kind of you to say, but actually I'm wrong most of the time when I try to predict the markets. So especially anything to do with timing. Okay. So if I happen to slip up and mention what I think is going to happen in the next 3 months, either ignore it or do the exact opposite and you'll be fine. But so a little of my background. I've been a finance nerd forever. Got an MBA in the 80s and worked on Wall Street for a while, and then started writing and I've written or co-written 5 books on investing and ran a website for like 15 years called dollarcollapse.com, which was a basic gloom and doomy finance and investing site. Just sold that a couple of years ago to some crypto guys, who had a lot of crypto money and came in and made me an offer I couldn't refuse. And now I'm doing a Substack newsletter at rubino.substack.com, which is mostly about actionable stuff. That things that we can do to prepare for what's probably going to be a really contentious and stressful decade based on all the debt we're taking on and all the other mistakes we're making. So far, so good with the Substack. It's an interesting community to be part of, and I'm enjoying the job.
Well, I happen to think that you're pretty daggone good at calling this stuff. I've read your books, a couple of your books anyway, and especially the one about leading up to the housing market crash and that you wrote in 2000, or you published, I think, in 2003. So that was well before the market collapsed. And I know it's not easy, talking about this stuff, but I do value your opinion. And, John, it doesn't matter really where we stand politically or geopolitically. I think that we can all agree as a nation that we have more financial debt right now than any other time in history. And so let's kind of start off talking about inflation, something that's been big in the news, and mainstream media now is trying to say that we've successfully, landed the plane, or they're alluding to that no recession kind of thing, and that they're considering, pivoting, dropping rates. But we know that inflation is really what is behind devaluing the dollar. And most analysts believe that the U.S. is in this financial mess today due to removing gold as the backer of the dollar. And so now that we're not dependent on this finite supply of gold, limiting, how much money we can actually print or create, the government can decide to print more dollars and just keep pumping liquidity into the U.S. and global economy. And of course, that's creating more debt. And from history, we've seen how this behavior has caused market bubbles, overvaluing like the stock market and what I'm in, the housing market, and what you wrote a book about. So, Is it true that printing more dollars is really the culprit of inflation, or is this a result of big government with like reckless spending habits that we know they have too? So can you talk about that?
Well, Todd, those two things are connected. When we went off the last vestiges of the gold standard in 1971, we basically handed all the world's governments, especially the US, but everybody else too, unlimited credit cards. In effect, they could basically, via a monetary printing press, create as much new currency as they wanted to and use it for whatever they wanted. So naturally, the governments of the world got bigger and bigger and bigger because there was no restraint on their growth. And, now we've got insane amounts of debts pretty much everywhere in every sector of every major society, which is the inevitable result of allowing governments to create as much new currency and encourage the creation of as much new debt as they want. And so we're where you would expect us to be, given what rational people know about human nature. And it's a really bad place because we've been taking on so much new debt that basically what we found out in the last couple of years is that this is all the higher interest rates can go. Because when you've got huge amounts of debt, rising interest rates increase your interest expense. And so if you look at a chart of government, for instance, the US government's interest costs totally spiked from like $200 billion a year to over $1 trillion now. And they've got another stat called personal interest cost, which is the costs that you and I and other individuals have to carry, what we have to pay on our debts. And that also spiked. It went from a few $100 billion a year up to 600 and some just lately. So those are debilitating numbers. In other words, you can't have your interest costs soaring like that without going broke. And so we basically figured that out. And that's why the Fed has stopped raising interest rates and is going to start cutting them pretty soon. Not because inflation is below their target rate, which it's not yet, but because higher interest rates are going to bankrupt everybody. All the major governments, most individuals now who have credit card debt or adjustable rate mortgages or adjustable rate business loans, anything like that, their interest costs are soaring. And it's going to become debilitatingly expensive unless they get interest rates back down. And this is a huge deal because it means we can never again raise interest rates. And when the markets figure that out, people are going to act accordingly and they're going to panic buy anything that can't be inflated away. And there's the investment thesis. You want to get ahead of that process.
So what about the debt? I mean, when we're talking about inflation, do we need the inflation to actually deal with the debt? I look at, in our modern age with computers, with, automation, the way that we are able to produce things now is certainly, much more efficient than before we had this technology. You take a look at like the television, for instance. I mean, what was $3,000, just 5 years ago or 10 years ago is now $200. Why is it? I mean, what is the point of creating, I guess, all of this inflation? Is it because we need it in some way to deal with the debt? And, how is the decision made, if devaluing the dollar is increasing more of it and we need more of it and we need inflation to deal with the debt, who decides when to print more money?
Well, the central banks of the world, basically, whenever they feel like things aren't growing fast enough, they create a lot of new currency and they hand it to the big banks. The big banks then give that money to their preferred customers, with which they then go out and buy real estate and stocks and bonds and make those things go up in value. So the rich get even richer. And the rest of us suffer with higher cost of living. But there's this group of people called Keynesian economists who would tell you that this is right and natural and how it should be, and that we should always have a background rate of inflation because that kind of greases the skids of capitalist economy. They're clueless. They're fundamentally and totally wrong. for a variety of reasons. But the biggest one is that once you start a little bit of inflation, that leads people to borrow more money, because if you see your currency being devalued, the logical thing to do is go borrow money and then pay that debt back in devalued currency. So a little inflation leads to a lot of new debt, which leads to the need for even more inflation, and so on until you spin out of control. And that is true always and everywhere. And that's where we are right now. We're in the mid to late stage of that process. So no, we don't need inflation. In fact, we in a healthy economy, the thing you mentioned about TVs getting cheaper and computers getting cheaper, that should be the dominant factor in the economy, and we should have deflation. In other words, as we get better at making things and smarter at doing it more efficiently, the price of stuff should go down. And in the 200 years, we had something called the classical gold standard, which basically ended in 1914 or 1971, depending on how you date it. The general price trend was down. In other words, we had kind of steady deflation for centuries, not decades, but centuries, because we were a healthy economy that was getting more and more productive with a constrained money supply. And that meant the prices of things went down. The cost of living went down for people. And it was a really healthy time financially and economically. We're the opposite of that now. And we're going to pay a horrendous price for screwing up like this. The experiment with non-gold-backed currency is only 50 years old. For all of the first 10,000 years of human history, money was a real thing. Usually it was gold. Sometimes it was silver. Sometimes it was other things, but mostly gold and silver. And that constrained the ability of governments to just go out and spend, invade their neighbors with borrowed money, stuff like that. You couldn't do that up until 1971, basically. And so we're trying this experiment right now with a form of money called fiat currency, which exists by government fiat or government decree, and is worth whatever they tell us it's worth. And that is failing on a monumental scale right now. So we're heading into the really chaotic part of the process when everything breaks down, and then we have to start looking at some kind of a monetary reset where we go back and figure out how we want the monetary system to work now that it's broken, and decide whether to go back to the old style of commodity-based currencies or do something new. So it's going to be a very fun debate, but it's going to be preceded by a horrendous stretch when, if you thought 2022 was bad from an inflation standpoint, you ain't seen nothing yet. It's going to be much, much worse and much, much more chaotic and much more destructive for regular people. So that's the decade we have in front of us.
Well, I definitely want to talk more about what you just mentioned, because I have a couple questions about your book, The Money Bubble, and how you think things will end. But all right, so now since the dollar is no longer backed, John, by gold, instead now it's said that the dollar is actually backed by the government's ability to create revenues from the dollar. What does that mean to ordinary people?
That's just economists speak for let us do whatever we want because we enjoy having power. Don't think in terms of the dollar being backed by anything, really. I mean, people value dollars right now because we are perceived to be the safest country, even though we're not in any financial sense safe, but we're better than the rest of the world. So people still want dollars. They choose to use dollars in international trade. But that's starting to end. And there's the whole BRICS coalition thing and de-dollarization that's going on right now. And all right, wait, let me answer your question first. What backs a currency, what makes a currency valuable is the perception that the people running the currency are competent and honest, and that they intend to maintain its value. In other words, maintain its supply at a fairly stable level, and in that way, make its value also be stable. That's not something you can say about our current government anymore, and that's the problem. That dollars are still considered valuable relative to euros and yen and pound sterling. That's because those other currencies are in even worse shape. We're basically all headed off a financial cliff, but just at varying speeds. So let me end here with that and see if you've got another question going forward on that subject.
So how do they create more dollars? I mean, they don't print them anymore. It's basically a journal entry. Can you explain like dollar creation and how is it actually infused? I know you were talking about they take that money, that extra money dollar that they're making, and they infuse it into the banks. But can you just kind of break that down a little bit? I mean, how do they make it? And, what's the travel from there?
Yeah, the Fed can create currency out of thin air with a mouse click. Somebody at the Fed prints or types in $100 billion, and then they hit send, and that money shows up on JP Morgan's balance sheet. Now, from there, JP Morgan is able to make effectively unlimited loans against that little bit of reserves they have, because there's nobody really paying attention to bank leverage. They have some rules, but banks evade them very easily with derivatives and things like that. So basically, the banking system creates money out of thin air by lending money. Like if your bank lends you $1 million, they didn't go get $1 million and hand it to you. They just made that $1 million up out of thin air and put it in their accounts. And all the banking system is doing that right now. So the money supply is what economists call flexible. In other words, it can be created in infinite quantities and it can be destroyed in infinite quantities. And since we've created absolutely insane amounts of debt and currency out there in the system, the destruction part is what has everybody terrified. Because, for instance, if a bank calls in a loan, that money that never really existed in the first place, but was spent by the recipient of the loan disappears. It goes to money heaven, as the phrase goes. Or if, for instance, in the housing market, housing is a really interesting example of this, because let's say you've got $50 million worth of houses at today's prices in your neighborhood. Well, you decide to sell your house at a 20% discount because you want to get out right away. Well, then that becomes part of the comps, and all the other houses in the neighborhood become less valuable. And so let's say, several $1 million worth of housing, quote unquote, wealth just evaporates. It just doesn't exist anymore. And that's the way the whole economy works, is all these things are just notional. There's all these financial assets out there that have value because we think they have value, because they're going to pay us dollars, let's say, in the case of a bond, over the next 20 years. Therefore, as long as dollars stay valuable, that bond stays valuable. We'll let the dollar fall in value and that bond crashes in value. And all the other bonds crash too. So you get this huge amount of what we think of as wealth just evaporating. And that's the big danger going forward, is everything that we thought was real money just ceases to exist. And, we're headed that way.
So a lot of it has to do with confidence. So let's get back to the backing of the dollar. Now, once again, the dollar's back, we'll just say, are guaranteed to speak of by the government's ability to create revenue from the dollar. So they're putting it into circulation with hopes that, they're confident that whoever the money's lent to will pay back the debt. But I mean, the U.S. is in debt. And isn't there deficit spending going on right now? I mean, John, do you have confidence that the government has the ability to create revenue from the dollar?
No. I mean, some tax revenue will come in, but that covers not a whole lot more than half of the government's deficit right now. So the rest of it is just made up out of thin air. And that's only going to expand, because a couple of things are happening right now that we probably should have seen if there was a brain in the head of the people running the system. One is that we have a demographics problem where baby boomers, my generation, we're all starting to retire. So we're not making any money anymore, but we're drawing down on Social Security and Medicare. So the government has this huge bill all of a sudden that's not covered by any kind of tax revenue. And they're just going to borrow that money. They're just going to make the money up out of thin air in order to pay baby boomers. The other thing that's happening is that with interest rates going up, the interest cost on the extant debt, which is a little more than $1 trillion a year right now, that also has to be borrowed. So we're in sort of a death spiral now where we're borrowing to pay our interest on our debt. And if you're an individual and you're doing that, or a small business, you're headed for bankruptcy, right? If you have to borrow more money to pay your interest, you're not a going concern. Well, the federal government in the U.S. and a lot of other governments around the world have reached that point where there's no way we cover retirement costs and military spending, because that's uncuttable, and interest costs anymore. We just can't do it without creating trillions of new dollars every year. And that then has to be paid off. That creates interest costs, which makes the next deficit even bigger, and so on. And the term for that is a death spiral. It's where your finances are so out of control that you're at 10,000 feet and doing barrel rolls and heading straight down for the ground financially, and there's no way out of it. So yeah, the government can generate tax revenues. And some people, especially those Keynesian economists, look at that and think, well, okay, we're solvent because we've got all these tax revenues coming in. But that can evaporate in a heartbeat if, like during the pandemic, millions of small businesses cease to exist, or if we continue to borrow to cover our own interest costs and the interest cost swamps tax revenues, then that doesn't work either. And we're headed for all of that. So wherever you look, there will be big financial problems that swamp the ability of governments to paper them over. And welcome to our next decade.
Is it really that complicated for the government to create revenue? I mean, you and I, being in business, you borrow money or you take on debt, and you hope that through budgeting, balancing a budget, common sense spending, that you would be able to pay off your bills, balance your budget, and make money. I mean, is it really that challenging for the government? Are we at a position, in other words, where this death spiral that you're talking about ultimately that's just how it's going to end? Or is there a way for, the right individuals to be able to make the proper decisions to eventually balance the budget and make money with the revenue that they generate?
No. The short answer is no. It's not possible. And remember austerity from a few years ago? That was a government policy where they were going to try to do what you just said, is to get their finances in order by cutting spending. Well, that didn't work politically. They all got voted out of office because austerity hurts
not popular.
A broad section of the economy. Yeah. Most people suffer from that. So if you try to broaden it out and you hurt the middle class and the working classes, there's a majority voting bloc that's going to kick you out. If you try to put the pressure on rich people, say have a wealth confiscation tax or something like that, like Bernie Sanders would do if he could, well, the rich just make sure you have an accident. And I'm not really. That's not hyperbole. They will literally kill you if you're a politician and you try to confiscate, 30% of billionaires' net worths or something like that. So the numbers can never be made to work, either mathematically or politically, once you've borrowed a certain amount of money. And that's where we are now. So we tried austerity. We tried cutting spending. That flat out didn't work. So the other alternative is to try to really juice growth. You borrow a bunch of money and you spend it, and you hope that generates enough tax revenue to more than pay for the interest on that debt. And that doesn't work either. We've tried that a bunch of times, or we've tried that actually continuously since the 1980s. And it doesn't work either. You cannot generate tax revenues at a level that pays off large amounts of new debt. You basically just end up with new debt, higher interest expense, and that zeroes out the benefit that you would have gotten from revenues and so on. So there's really no way out of something like this. Basically what happens, in human history, countries have tried this a bunch of times, where they screw up their own currency. They borrow too much, they debase their currency, they have a currency crisis, they collapse. And then they start over with sound money. But what's different today is that the whole world is doing it. It used to be like one country would do it in the context of a sound money world. Everybody else was on the gold standard. And this one country tried a new experiment with fiat currency, and it blew up on them. And they either got invaded because they were so weak, or they had to hunker down for a long time to kind of rebuild the semblance of a working state. But this time, every major government is doing the same thing. So there is no broader sound money world in which this is going to happen. It's going to happen all at once or on a rolling basis across the world. And, that makes it new. So it's hard to predict. You can predict, that everything will happen to everyone as it did to individual countries in the past, but that's not guaranteed. Could be much worse because it's happening everywhere and there's nobody to rely on to bail out anybody else.
I want to talk about how I believe most people view the dollar. We teach very little in the U.S. on financial literacy. And I think with limited education on the dollar, we like the government maybe sometimes spend more than we make. And most probably, think about the dollar this way. I mean, if you have, it's like I said, it's confidence. If you have the money in your pocket, you can buy what you need to live on today, tomorrow, next month, and perhaps next year. This is also why people take out loans. They believe that they'll have the money in their pocket to continue to make the loan payments. With the dollars in your pocket, you also have the confidence that if you walk into a restaurant and pull out your dollars, that they will probably gladly accept your dollars to pay for your meal. But what if they no longer want your dollar, or when rising prices suddenly cause the dollars in your pocket to no longer be enough? And this is kind of what's happening right now as the money in our pocket is literally disintegrating. So, what that's called, right? Inflation, rapid or hyperinflation causes a dollar to disintegrate even faster as wage growth doesn't keep up. And John, that's a big problem that we've had. This is one of the reasons why we have this debt crisis. We take out these loans. We buy more than what we should because our confidence in the dollar that's in our pocket. So, you spoke a little bit about it earlier on about the debt crisis. We speak of the government being in debt and now consumers being in debt. But just how bad are we right now? Is this something that we, people want to say, 2024, this is going to be massive, terrible times, big recessions. Then other people are saying the Fed's successful and our economy's strong. Where do you think we are?
Well, remember what I said early on, don't ever trust me about timing, So if I talk about the year ahead, that's coming from somebody who tends to get the next 6 months wrong pretty regularly. But my take on where we are right now is that we have a bunch of people, politicians and economists, saying, wow, look at these headline numbers. Unemployment is this and inflation fell to that. And we're actually in great shape. But in Keynesian economics, which is their framework for viewing the world, you don't look at debt. You don't pay any attention to debt. You only look at something called aggregate demand, which is how much stuff people are buying. And they don't care how much you have to borrow to get people to buy that 3% more each year amount. And that's why Keynesian systems tend to blow up, because they're not paying attention to debt. Debt goes up and up and up, and eventually it becomes unmanageable. And I would say that that's kind of where we are now, because we borrowed huge amounts of money, even over and above what we were borrowing before, which was a lot. And during the pandemic, we borrowed even more. And we caused inflation to spike, because eventually an increasing supply of currency will make prices go up. And that's what happened in 2022. So we got this whole category of people, a big category of people in the US who were just making ends meet in, say, 2019. But then we had this, first of all, the pandemic lockdowns, and then we had this burst of inflation. And all of a sudden, the people who were just making ends meet are now trying to decide whether to, or which to choose and which to shine on. Whether they are going to drive to work this week and put gas in the car, whether they're going to feed their kids, or whether they're going to pay the rent. They don't have enough money to do all three of those things. And you can see that in the statistics, which no Keynesian economists are paying attention to, but which we should be paying attention to. In, for instance, personal credit card debt and the interest that is being charged on that debt right now. You've got a growing number of people who are putting day-to-day life on credit cards and then carrying balances at 25% on those credit cards. And that, clearly you go bankrupt in a heartbeat if you're trying to do that. But we've got a growing number of people who are doing that. What that means for the economy going forward is that, it doesn't matter what inflation is. It doesn't matter what I'll get to the unemployment numbers in a sec because they're patently absurd. But basically, if a growing number of people are putting their lives on plastic and carrying these big credit card balances, then consumer spending is going to be slow going forward, right? Because those people are not going to go out and buy a new car or take a nice vacation or anything. They're going to, decide whether to feed their kids or not. That's the extent of their spending. And that's going to slow the economy down. So I think in the year ahead, there's a decent chance we have a consumer-driven recession when consumer spending just falls off a table. Now, those unemployment numbers that make the economists think everything's okay. Here's what the government does. They'll report a headline jobs number and they'll say, last month we added 250,000 new jobs. This is great. And then the New York Times and the Washington Post will pick up on it with optimistic headlines. And so everybody will think things are okay. But two things will happen at that point. One is that in subsequent months, the government will go in and revise those nice headline numbers into much lower numbers that would be seen as disappointing if they were the headline number. The other thing is that analysts will dig into the unemployment numbers and they'll see that one, full-time jobs are shrinking and part-time jobs are rising. And that's not a sign of a healthy economy when people are losing their full-time jobs and having to cobble together a few part-time jobs in order to pay the bills. And the other, this is a new stat that I'd never seen before, but just showed up this last jobs report. The number of people carrying two full-time jobs is soaring. And now, part of that is that you've got techies out there who are good enough to do one tech job in 20 hours a week. So they go out and apply for another tech job. And so they've got two full-time jobs and they're able to fit it into 40 or 50 or 60 hours a week. But it's also probably true that a lot of people just can't pay their bills with one full-time job, and they feel forced to take a second full-time job, which is a recipe for a nightmarish life, right? Imagine working two 40-hour-a-week jobs, or living with somebody that's doing that. You could never make a noise because whoever's got those two jobs, anytime they're home, they're sleeping. So you need to be quiet. It would just sound like a terrible life. And so that's what they're calling a good, strong economy when it's really not if you dig into the numbers. So combine, deterioration in the jobs market with a slowdown or a contraction in consumer spending, and you get a garden variety recession next year, along with probably an equities bear market. So stock prices will tank, house prices will tank to get to your area of expertise. And a lot of people will be thrown out of work. That's how recessions work. And we haven't really had a serious one since 2008. So we're overdue in any event for one. But when this one happens, it's going to happen with an immense amount of debt out there that can go bad. So this might be one for the record books. It might be scary on a lot of different levels that the mainstream media and the government economists are not yet expecting.
Yeah, and John, and also combined with the fact that I just recently saw on yahoofinance.com that I think the number was 439,000 of those jobs they were touting about last year were silently erased from the report, so that they were well overstated. And we see that with non-farm payroll, they're constantly adjusting that down. They come out with the rah-rah session. So, do you think that we're going to see a big uptick in consumer loan defaults and bankruptcies?
Oh, we already are seeing that. Credit card delinquencies are spiking. Car loan delinquencies are way up. And I'm not sure in the housing market, but I think the housing market is coming for reasons that we can go into more depth in if you want to. But consumer debt has reached a record high, and wages aren't keeping up with that debt. So you're going to see a lot of people default on their debts. And credit cards, obviously, like if you're carrying a 25% credit card balance, you basically need to just stop paying those debts, And um, my son had a little bit of credit card debt a while ago, and I advised him just to stop paying, and just what can they do? They can mess with your credit rating. That's all, and who cares? It's probably better to have a bad credit rating because then you aren't tempted to take on more debt. So that's coming. And have you seen the videos about the car market lately? There's a really interesting subgenre of guys walking around car lots and going, look, it's pickup trucks to the horizon. Nobody's buying pickup trucks, and basically their point is that the car market, which was very strong 3 years ago because there was a shortage of parts and everything. And so you couldn't get a car because of supply chain issues. Now there's an oversupply of cars. And because of that, used car prices are coming back down, and new car prices are going to have to come back down because nobody's buying them. And that's a recessionary signal when you've got people walking around making videos out of stuff like this and assuming they're telling the truth. But I kind of think they are to an extent.
Was it you, John, that has the RV theory? Is that your work? I think I heard a podcast with you talking about you're following the RV market, and when that slows down, it's a recessionary signal.
Yeah, this came from that is me. This came from me living in suburbia for a while, and in the suburbs, think of the RV indicator as more of a big toy indicator, because basically what happens if you're living, in a nice house in the suburbs and you got your job is going well and everything, you buy yourself a boat. Then you buy yourself some jet skis to go with the boat because you want your kids to think you're extremely cool. And then maybe you get a motorcycle if your wife will let you. But if not, you start thinking about an RV. And so the RV usually comes at the very peak of the cycle after you've already bought the other stuff. And so you buy this basically house on wheels, which there's an RV subculture of people who more or less live in their RVs and they travel around and they have friends everywhere. That's cool. But the big toy aspect of RVs is people who are overconfident because things have been good for so long, buying extremely big toys that they probably don't need, and then 2 years later having to sell them for 40% off or whatever because the job didn't work out as well as they thought. Maybe they're going to sell their boat, maybe they're going to sell the jet skis, maybe the RV. They start dumping their big toys. So you can tell from a market like the RV market where we are in the economic cycle. When RVs are just flying off the lots at MSRP plus prices, we're at the peak of the cycle. And what's happening now with RVs is that they're harder to move, and you can get good deals on them because so many people are having to sell them. And they're taking whatever they can get. And that means we've peaked and we're heading into some kind of a slowdown. And, I suspect that it's the same for boats and jet skis, but I'm not really watching them as much as the RV market.
All right, John. So we're going to dive into your book here. I have it. It's called The Money Bubble, and a book that you wrote with your co-author. And one of the interesting paragraphs that I found was where you talk about over time. And I want to kind of get where you're thinking, where we're going from here. So over time, beyond our typical lifespans, over the centuries, hundreds of societies, you touched on it earlier, have borrowed and created debt in whichever currency was denominated. And this debt seems to run a repeat cycle, which you just mentioned a while ago, beginning from an excessive borrowing phase, an inflationary bubble of some sort, and then the final phase of our economic cycle, we have some type of economic crash. We know that from where you predicted the '08 crisis, the housing market and real estate crash. What phase are we in today? Are we still in the cycle of inflating debt? Are we in the bubble? Or are we entering into the phase of economic crash?
Well, we are in the blow-off phase of a 70-year debt supercycle. In other words, the economy of the past 70 years has been defined by finance, more and more debt being taken on to finance bigger and bigger things. And we're close to the end, I think, based on the recent numbers and the way interest costs are starting to spike. And basically what has happened now, we don't have the tool of tightening money temporarily to kind of take some of the steam out of a credit bubble. Because we know if we tighten and interest rates go up, then debt costs just soar and they start bankrupting everybody in sight. So all we have is easy money right now. And if that's appropriate, like in the next recession, we'll cut interest rates like crazy and we'll start creating a lot of new currency out of thin air in order to stop the system from falling into a 1930s style deflationary crash. And then we see if it works. And I suspect it won't, because the amount of new currency that it's going to take to keep all that bad debt at bay, to paper over all our past mistakes, will be so immense that it'll cause inflation. And so we'll get a spike in inflation and we'll realize there's nothing we can do to fix it, because we can't tighten ever again, because that just makes things worse. So we're right at the end point of the credit expansion. And we're getting ready to tip into the Great Depression era part of this process. There's a thing called a long wave theory, and they have different names: the fourth turning and Elliott wave and Kondratiev wave, that talks about this, how long financial cycles are basically psychological cycles for humans. And we start out shell-shocked from the past crash that's still kind of recent in our minds. And then we're very conservative for a while, but then we find out it's okay to borrow a little bit of money because that helps in the moment. And then we have to borrow more to cover our debts on the last. And then the credit cycle really starts to ramp up. Well, we've been doing that for a really long time now. And we're at the end point where our debts become so immense that there's no way to fix it, and we just collapse. And that was the Great Depression in the 1930s. And those long wave theories say that really we should already be in a Great Depression. But this time we've been able to bail ourselves out thanks to us all having monetary printing presses. We were able to run the inflationary engine longer and hotter than we would have been able to do in past cycles. So we bought ourselves an extra 20 or so years, but we didn't violate the laws of finance. Those laws of finance still apply, which is to say, when you borrow too much money, your life spins out of control. So we're pretty much there now. And, you can't say it happens next year. Can't even say it happens in the next 5 years when things just crash. But based on human history, we're heading into that stage of the credit cycle, of the credit super cycle. And at some point, everything falls apart. And that's, on my Substack, the actionable part of this stuff that I write about is basically, how do you prepare for that kind of an eventuality? What should you be doing with your job and your investments and your general prepping? How should you behave in your community with, facing something like that in mind? And so it's an interesting intellectual challenge. Like, how do you completely prepare for something like that, which is maybe as bad as the Great Depression, or maybe as bad as the Weimar Germany hyperinflation in the 1920s? Something that is just inconceivable to most people, really destructive for most people's lives. And how do you get through it in good shape and maybe even make money in the process, And that has been done in the past. And how do we do it in the near future?
How do you feel that the Fed has done through the last several years? I mean, Powell specifically. I mean, do you think he's done a good job? Do you think that they are making mistakes? Do you think that, you spoke earlier of it's expectant that interest rates will come down, they'll drop rates. He spoke about it. What do you think? Do you think he's done a nice job? Do you think that he can land this plane for not having a recession in the near term?
No. The Fed, I'll give you two metaphors for the Fed. The Fed is a drug dealer who's purpose in life is to shoot more heroin into a group of addicts, which is the economy. And the only thing he can do is keep raising the dose, because that's how addiction works. You need higher and higher doses until it kills you. The other analogy, or is it metaphor? You tell me after I say it. The Fed's the arsonist who sets fire to your house. And then we call him, we call the Fed to come and put the fire out. And if they put the fire out, we tell them they did a good job. But they set the fire in the first place. And they'll set the next bigger fire too, because they are arsonists. That's what they do. So there's no way, you have to go back all the way to the 1980s for an example of the Fed doing a good job. Ever since Paul Volcker, the Fed has been catastrophically incompetent and or corrupt. And, the Fed that we have now is an example of that. Why are they raising interest rates right now? Because it's an election year. If they were actually trying to wring inflation out of the system and get inflation back down below 2%, well, it's like 3% and change right now. So they'd still be raising rates if they were actually trying to stabilize the value of the currency. But basically, I'm pretty sure this happened. Jerome Powell, the chair of the Fed, got a phone call from the White House. And they told him, listen, if you want to be part of the financial establishment for whatever's left of your life, you don't want to be raising interest rates right up to a presidential election where we need to be reelected. So you need to start cutting, and you need to start doing it now. So the Fed is doing it now, or they've stopped raising and they're going to start cutting pretty soon. But not because they're competent or anything. It's because they got some marching orders from the people who sign their paychecks. That's all there is to it.
A lot of talk about rates dropping. I mean, I think that is just a mess how they calculate CPI and inflation in the first place, the sampling of the data and how they come up with these numbers. But one of the things that we have, and I agree, I mean, we're in the middle of an election cycle. I mean, the worst thing that we need right now for the current administration is, housing foreclosures and, rising unemployment rates, people losing their job. How do you feel? I mean, right now we have a issue in the Red Sea that seems to be ramping up. I mean, we have, the Panama Canal is dry. We're looking at some major potential supply chain issues, some major problems with getting our imported, goods to the States. What do you think that will do? I mean, do you think that is going to push inflation higher at the same time that the Fed is trying to make these cuts, saying that inflation's great? I mean, how are they going to get around that?
Well, supply chain issues are definitely a real thing. We saw what a messed up supply chain was like during the pandemic, right? Where you just, not only were prices high, you couldn't get stuff. If you wanted something, you'd have to go on a waiting list, and in 6 weeks you could get whatever it was. Like if you needed a washing machine for your house or something. Well, we've got issues like that still, and part of it is geopolitical. There's wars everywhere you look right now, and a lot of the combatants are part of complex global supply chains like agricultural or microchips or whatever. You can't necessarily get those things that used to be just obvious, and your birthright as an American to get whatever kind of computer you want. Well, it's not as easy now as it used to be. The other thing is that because of recent geopolitical issues, in other words, the U.S. picking fights with everybody out there in the world and sanctioning them and everything, there's a process going on called reshoring or friendshoring, where it doesn't make sense anymore to have 10 company global supply chains for a given product, because if you take one link out of that chain, the whole thing breaks. So now everybody wants to bring their factories back home. And I think it's a good thing, because that means your factory workers who get to unionize and make good money at home, making real stuff. But it's very expensive to get from here to there, because the old global supply chains used to be incredibly efficient and prices were really low because of that. Now we got to pay to set up these factories, and the factories are almost by definition not going to provide things as cheaply as, say, a Chinese factory where the average worker makes $5 an hour, right? You're going to be using unionized workers in the U.S. These guys are going to be making $30 or $40 or $50 an hour. All inclusive. So the products they make are going to end up being a little more expensive. So you've got inflation coming from two different directions there that can't be avoided. So we've got built-in structural inflation while we're in this transition. And, let's say it's 2 or 3% extra inflation a year as this goes on. Well, that's just the way it is. And we have different ways of dealing with it. One would be to raise interest rates dramatically, to start paying savers and punishing borrowers, which is the way a healthy economy ought to work, and just, eat the effects of that. But in that way, you help, people get good jobs in factories here, and their savings that they generate from their paychecks get a good return. So you're creating a just economy by doing that, and that's probably good policy. But you got inflation as that happens, and I don't think there's any way around it, because there are too many reasons for there to be inflation, and we can't fix them all.
Well, that doesn't sound good for the banks. If people can pay cash and actually, not be in debt to the bank. Speaking of the banks, a lot of people say that they are in trouble. The banks themselves, are feeling, as we said, pain from high interest rates. In the great financial crisis, the Treasury Department, and I think this is crazy, bailed out hundreds of banks and invested back then about $200 billion into these hundreds of banks. And we look at it today and we go, well, that doesn't sound like a whole lot of money. But they did so through its capital purchase program in an effort to prop up the capital and support new lending. As you have said, in March of 2023, Silicon Valley Bank failed. 2 days later, Signature Bank failed. May 1st, First Republic Bank failed. And then July 28th, Heartland Tri-State Bank failed. And then finally, last year on November 3rd, Citizens Bank failed. John, who's next? And, besides, printing money, I mean, what do you think is going to happen to, the banking sector over the next 12 months?
Well, the problem with the local and regional banks, which is the vast majority of banks in the U.S., though in number, but not in assets, but they take in deposits from locals, and then they lend that money back out to local businesses and local homeowners, and so they and whatever's left over, they buy bonds. They buy like government bonds. So what happened when interest rates went up is that made the value of those government bonds on the bank's balance sheets go down, because interest rates and the value of a bond are reciprocals of each other. Higher interest rates mean lower value for the bonds. So the little banks have all these unreported losses on their balance sheets. And as long as interest rates stay where they are, at some point, the banks have to take those losses and report those bad numbers. That scares away their depositors who pull all their money out. And then those little banks have to sell their investment assets in order to pay off the depositors. And they have to take even bigger losses on those forced sales. And so you get this death spiral for the banking sector. And that's what we were kind of looking at with Silicon Valley Bank. We were afraid, the government was afraid, that all the little banks would have to do a fire sale of their assets, and it would destroy them. And the government would have to bail them out to the tune of, $3.5 trillion or whatever. So they stepped in and stopped the bleeding right away, but they didn't fix the problem or anything. Those loans are still on the bank balance sheets. And now we've got commercial real estate heading into a big crisis here. If you look at what's happening with office buildings, to the extent that they're being sold at huge discounts, like 50% off the price from 2018 or whatever. And part of the reason that's happening is because during the pandemic, a lot of people got to work at home. They found out they really like working at home. They don't want to go back to the office. So all of a sudden, there's a lot of extra office space out there that's empty and that isn't generating any cash flow for the landlord of the building, which means the building is worth way less, which means every sale involves some big, huge public loss. And a lot of that debt is on the balance sheets of these little banks. So they're not out of the woods yet. They could still have a really big banking crisis as these office buildings and to an extent apartment buildings start being sold at big losses and the banks have to take those losses. So that's potentially a 2024 story. That could happen in the coming year.
You mentioned office buildings. I have a client right now that we looked at an office building where it's in receivership for Wells Fargo. And the tax assessment right now is $6.9 million, and they're trying to get somewhere around $3.5 million for the building. So, almost half of what its assessed value is, which is, that's massive. And to be honest with you, I don't even know if it's worth that because, it's like, 40,000 square feet of office space, and who wants that? And, so it's a mess there. If we look at a massive banking crisis here in 2024, let's just say, we see commercial loans implode. And by the way, I know, people that have had their commercial loans balloon. I was one of them. I had a building that I had to pay off because it was, a 10-year balloon, and the bank was unwilling to refinance, a bank that I have a great relationship with, and I'm a really good borrower. And but I made a decision rather than try and put it out to another bank. They just didn't have an office space, appetite, and they're trying to reduce, especially a lot of their less expensive, loans. So, but I know for a fact that I have clients and friends of mine that have ballooned and their bank hasn't done anything about it. They just gave them a 120-day extension. They don't want to rock the boat. They don't want the property. They don't want to refinance it. The financials don't look good because of high vacancies and they're not making money on them. So the bank's just saying, okay, we're just going to sign an extension. So that is building, like you said. But what do we do? What do you see coming? So if we look at consumer debt being outrageous, and we're going to get ready to talk about the housing market, but when we look at, people struggling to make their loans, FHA right now, almost 10% in delinquencies after multiple modification rounds and, different types of stimulus and things like that. And so we see a crisis on the horizon for consumers. We see a crisis on the horizon for our businesses, our commercial property owners, apartment owners. We can see all of this and we could talk for days about it. But when we get down to it, the way I look at it, and I don't know what you think about this, if this will be a possibility as we're in an election cycle, do you think they're going to create more stimulus for consumers to actually get rid of some of this debt? The student loan didn't pass, right? Where they were, a lot of people had many years to pay down their student loans at 0% interest, but they didn't. Many of them didn't. So now they're looking at paying $500-$600 a month on that. That started last year, end of last year. What do you think the answer is here? If we're looking at this massive implosion and you're saying that it may be another several years before the end game where we have a dollar collapse, what do they do in the interim? Print more money and hand out consumer stimulus?
Well, I think they'll try, but the numbers are so big that they risk reigniting inflation. And people remember what inflation was like because it was just 2 years ago. So as soon as people start seeing eggs go to $7 a dozen, a loaf of bread, $6, when they see that again, or they see it rising from already high prices, they see the acceleration start again, people will panic and they'll start panic buying stuff like we did at Costco there for a while where everybody just hoards and that makes prices go up even more. So things will spin out of control very quickly if inflation picks back up because everybody's got it so fresh in their mind. So Yes, they will try to juice consumers up to keep us from dipping into a recession, or they'll miss that signal and they'll try to pull us out of a recession by easing aggressively. But they don't have the same tools they used to, because we already know what inflation is like. So I think it doesn't work as easily this time. And I don't think you fix commercial real estate with any of that. I think the only thing you can do when collateral has plunged in value is liquidate it, take the loss, and move on. And the problem is that we're talking multiple trillions of dollars in this case. But there's no other way to do it physically. I mean, the government can step in and bail all the office buildings out, for instance, like they did with houses back in 2008. But that's a massive amount of money. And that this time around is liable to spook people and cause them to do things that are counterproductive from the government's point of view.
Well, I think with the housing market, I mean, they gathered up all of those foreclosures and sold them to Wall Street. I think they fueled a much bigger problem back then. I'm kind of curious to see what happens now. But let's talk about the housing market. Many believe that we've already seen the bottom. Now, that's my business. I mean, we're now talking about, John, what I do for a living. And a lot of people, I'm very bearish, by the way, on the housing market. I think that the numbers don't make sense. We're at that point where, when houses are trading at 8 and 9 times earnings, median income, it doesn't work, right? But a lot of people feel that the end, we've seen the end, and that, if they drop interest rates and the bond, market, the 10-year treasury lowers, that we'll see maybe 4% mortgage rates again. Who knows? But we know that, let's just say, close to 80% of the home buyers out there, they can't afford the mortgage payments now for the price of the home. What is your take on the U.S. housing market?
And my take is you should try to sell all your real estate to those optimistic people right away, as soon as you can do it, because there's no way this is the bottom for housing. Houses are more, like you said, they're more unaffordable now. In other words, house prices are high relative to the incomes of the average American. And to an extent that we've never seen before. So most people just can't buy houses, even if they want to. And then there are 3 big reasons why we could see a housing crash. And one of them is demographic. Baby boomers, we're kind of at the midpoint of the retirement process now. The average boomer is like 67. Normally, the way it happens when a generation reaches retirement age is that they downsize, right? You don't want a 3-story, 4,000 square foot house if you're 75 years old and you need a hip replacement, right? That's the wrong place for you to be. So boomers have not yet started dumping their real estate, but the time is coming when they kind of have to, because they just physically are in inappropriate places, and maybe financially, because they don't need that 4,000 square feet, right? They can get by on 1,500 square feet if it's just the two of them, because they're empty nesters. So the normal demographic process has yet to kick in, but there's no reason to think that it won't, in which boomers start dumping their McMansions. That's going to be huge, because who's going to buy the boomers' McMansions, right? Well, millennials? Highly unlikely. Another thing is the Airbnb entrepreneurs. Because this is the first cycle in which individuals went out and bought like 17 houses to Airbnb. And it's now turning out that Airbnb is not as good a business as a lot of them were led to believe. And because of that, they're not making nearly the money they thought they were going to. And a lot of them, they have debts and things they've got to pay off, which are rising in cost. So a lot of Airbnb entrepreneurs are going to have to dump their houses too. So you got those two sources of supply, and then you got Wall Street, where these hedge funds and private equity guys came in with 0% money and bought up entire neighborhoods to where they were going to jack the rents up and rent them out and everything. And that's not working out quite as well. Remember, I mentioned there are all these videos with guys going to car lots and saying, "Hey, look at all the pickup trucks." There's another version of that with realtors walking around their neighborhoods, whether it's Vegas or where else, Seattle, someplace like that, and going, hey, just the other day, or just a couple of years ago, a private equity group bought this house for $1 million, and now it's back on the market for $650,000. This market is going to tank. So that's a subgenre of YouTube videos too, and I think it's valid. The supply-demand situation in housing is about to change in a monumental way, where a flood of new supply comes out that people still can't afford, because the initial prices that, say, Airbnb guys or hedge funds are going to put on their houses, the asking prices will still be far out of reach of the average person working 3 jobs just to cover the rent, So house prices have to come down by 40% before they reach what would normally be thought of as affordable, average affordability. And interest rates also have to fall dramatically before your mortgage rate is low enough to make that house affordable. So all of that has to happen, and it's going to be brutal for housing. So I think the next couple of years are just going to be, funny if you're on one part of the market, and horrifying if you're part of the other part of the market. So we just have to, see where we're positioned for this.
Yeah, I think less horrifying for the baby boomers that don't have mortgages, and they still, they bought their homes 25 years ago, so they still have plenty of equity. Horrifying for anyone that has purchased a home in the last several of years that all of a sudden now needs to sell because they're changing jobs and going to a different state, or, they're struck by some other financial crisis or life circumstance where they just can't stay in their home. I saw where one article called it a silver tsunami about the baby boomers, and people want to say very quickly, and we have amnesia, and that's part of what reading your Money Bubble book, which I recommend everybody read. In fact, I'm going to drop the link in the show notes below, as well as your Substack. I'm a subscriber to that. I love your work, but I think that when we look at, people want to quickly say that home prices will never come down because it's a supply and demand issue. And what they're really not considering is what you just said. We could see 30 million houses in the next couple of years go on the market. Now, in a world where a normal market would be 6 to 7 million homes sold a year, which would be a very healthy real estate market. This year, we didn't hit, and this is existing inventory, we didn't hit 4 million in sales, way down even from last year, which was low. But people quickly, they get amnesia. And in your book, I think you called it something like, we forget about our grandparents sort of thing. And you made mention to it about how, we go through a depression and then we're directly related to that. It's because it was our parents, or, and then 2 generations later, we have amnesia to it. So I think most of the people in the real estate industry that are cheerleading it didn't go through 08. Most of the loan officers, most of the real estate agents today, and a lot of the people that have bought homes at these higher prices, they don't know how quickly things can change. But if we see, 15, 20 million houses go on the market in the next 12 months, it would be catastrophic to home prices and the housing market. So the buyers, of course, would be very happy. I want to get to one last thing as we kind of, land this plane today, John. I feel like you believe we'll eventually see a complete fiat currency crash here in the United States, maybe globally. It will be a massive event, maybe even worse than the Great Depression. But ultimately, nevertheless, it'll have a global impact. And certainly, if it happens sooner than later, a lot of people are really going to be caught by surprise. But getting back to your book, The Money Bubble, you talk about the end game. The destruction of fiat currencies is inevitable, and you talk about how we get there. And you mentioned a few possibilities. One was cracked up boom. One was currency war, catastrophic failure, cyber war, debt jubilee. Now that your book is, was written 10 years ago, now we're 10 years down the road, and you're seeing how everything is playing out. Which do you believe of those things I mentioned will cause the ultimate dollar collapse?
The jury's still out, because all of that stuff is a possibility. The crack up boom is a term from the Austrian School of Economics, which is the point at which people realize, or a critical mass of people realize, that it's the official policy of the government to inflate away the currency. In other words, prices are going to keep going up from here. And so they act accordingly. They hoard everything in sight. And then every time they get paid, they dump their currency by buying real stuff that governments can't inflate away. That manifests as hyperinflation, but it's really a loss of faith of the currency, in the currency. And, I think we're in the process of something like that happening already. The other stuff, the monetary reset is what comes after the crack up boom. In other words, the currencies just stop working, and nobody wants to hold them. The value plunges, the price of things go through the roof. And then we have to kind of sit down and figure out what to put in its place. The old monetary system is broken. What do we do now? And that'll be a very interesting conversation. I personally think a new gold standard is probably what we'll end up with, because that's understandable. When you're in kind of uncharted territory, it's comforting to go back to something that worked in similar circumstances way back when. And so probably what will happen is we just, some Sunday night, we just announce that henceforth the dollar is just a name for 1/10,000th of an ounce of gold. And then going forward, boom, we're on a sustainable system. Although everybody who kept dollars and trusted the government, they're all impoverished, and you're going to have some serious civil unrest as that works itself out. But something like that would be the least painful way of getting from here to there. But, the civil unrest, violent revolution kind of thing, which frequently happens during financial crises, that's always possible. I hope not. That would be horrible if it did happen. And, we can hope that at some point the people in charge just decide that the least bad option is a currency reset with a new sound commodity-backed currency going forward. And hopefully that's what we get. But there is, there's no guarantee of anything once things start spinning out of control. So all you can do, because we can't stop that. We can't really do anything about the momentum that the world's financial systems have as they head towards that cliff. But we can manage our own lives in ways that increase the odds that we come through it in pretty good shape. And I think that's the intellectual challenge for most people. Once you figure out that, okay, the world's going to hell, what do I do? And what you do is something you can control. So that's a psychologically healthy way of approaching this.
Well, John, we really appreciate your time. This was really packed with great information, and we thank you so much.
Thanks, Todd. Enjoyed it.
Wow. I hope you enjoyed John's interview. If you did, you can smash that thumbs up. It'll let John and I know that you did. And I'd love to hear from you. You can drop your comments below as to what you think is going to happen. Do you believe in John's analysis? Or what are you thinking for the year ahead? As always, guys, I appreciate you. Thanks for watching. And if you haven't subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. And please don't keep this information all to yourself. The best compliment that you can do for me and Sachs Realty is to share this video with your family and friends. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.